There's an advanced tax planning strategy growing in popularity that has huge potential to improve your tax picture. However, it also has a huge gotcha that you need to look out for. I'll explain the strategy and the gotcha so you can avoid it. That and more coming up. The U.S. tax code is the most complicated tax system on the planet, and it's not something to brag about. It is full of rules and then exceptions to those rules and then exceptions to exceptions. I've heard it said differently. It is full of opportunities and then gotchas, okay? And boy, with the plethora of tax law changes that we've had over the past several years, it's becoming even more and more that. Well, on top of that trend of more and more complexity coming to tax laws, there's been a couple other trends that are leading many people to a more creative tax planning strategy, one that we've shared with you before, that I want to draw your attention to right now. Here are the couple trends. One is that due to the recent tax laws that were passed in the summer of 2025, it does look like that for at least the next 4 years, more people could itemize their taxes based on the increased to the state and local tax cap, the SALT cap. So that's one possibility, that more people will be itemizing, that it's temporary, and so you should optimize. Well, if you're going to itemize, well, how can you take advantage of it to the greatest potential? Okay, so that's one trend. Another trend is just with how the market has moved over the past 3 years, the stock market. Odds are, if you have some dollars saved up, invested outside of your retirement accounts, growing taxable in a joint account, individual account, trust account, it's likely you've got some highly appreciated securities. So if you believe that you're going to itemize your taxes this year and maybe for the next couple, while this SALT cap is at a higher level, 40,000 before it goes back down to 10 grand, and you've got some appreciated investments, some appreciated stocks or mutual funds, exchange traded funds outside of your tax shelters like your 401k or Roth IRA. If you've got those two things and you're charitable, enter the possibility for a level 3 tax planning strategy, combining multiple tax planning strategies to create an even more powerful and potent tax beneficial strategy. Here's how it works. Step 1. Stop donating cash to the charity, to the church that you care about. That's number 1. Number 2, open a donor advised fund. If you're not familiar with these, we've done a lot of content on these. These are a creative tax planning strategy, basically creating your own little giving fund or your own mini foundation. Whereas you donate money or assets into the donor advised fund, the year that you make the donation into the donor advised fund, that's where you get the charitable deduction. That's where it counts on your taxes. But then within the donor advised fund, you can disperse dollars from there to different charities of your choice. You can continue to invest the dollars. You can sell the dollars if you donated assets. So step 1, stop donating cash to your charities. Step 2, open a donor advised fund. Step 3, and this is where it gets really, really impactful. Instead of donating cash to your donor advised fund, donate the highly appreciated securities. Donate that exchange traded fund that has, surged 50% in value over the past 3 years. Donate that to your donor advised fund, because when you do, again, in the tax year that you make that donation, that's when you get the write-off on your taxes. That's when it will count as a donation that will qualify as an itemized deduction. And if you're planning to itemize because of the SALT cap increase, now you've got an even greater charitable donation to expand and optimize your itemized deduction. That's step 3. And then step 4, take the cash that you were otherwise going to give to the church or give to the charity, put it back into your non-retirement account and repurchase that same investment that you just gifted into your donor advised fund. Those 4 steps help you optimize your itemized deductions, potentially expanding your deductions, creating even more deductions and more benefit today on your taxes. Number 2, helps you to potentially avoid capital gains tax completely, right? Because if you're donating appreciated securities and not having to sell them when they're at an elevated level, you're not having to pay the capital gain tax. And then when you sell them within the donor advised fund before you gift those dollars off to the church or off to charity, that donor advised fund, that's a not-for-profit. So they're not paying capital gains tax. So second benefit is it avoids capital gain tax altogether. And then third, you continue to support the church and the charities, the causes that you care about, and we're going to benefit with cash anyway. You're doing it with the same amount of resources, just in a way that leverages even more tax benefits. That four-step strategy of opening a donor advised fund, donating appreciated investments to that donor advised fund, and then gifting them to charity, and using the cash that you were otherwise going to give to charity, use that to buy back the investment. That strategy, more and more people are waking up to this idea, if the circumstances are right, and have begun adopting it here in 2025 and plan to in 2026. Very potent strategy. However, it has a big gotcha. One of the benefits of this strategy is when you're donating appreciated securities, you get a deduction, you get a write-off on what the market value is of that security, right? So let's say that you bought it, we'll keep it very simple. Let's say that outside of your Roth IRA, outside of your 401k, in a non-retirement account, you invested 10 grand into an S&P 500 exchange traded fund, okay? And that 10 grand has grown to $15,000. Well, you were going to give $15,000 to the church, maybe over the next year, something like that. But instead, you're going to donate this $15,000, those shares of your S&P 500 exchange traded fund, donate those to your donor advised fund. You get a write-off of that $15,000, the appreciated amount, and then you use your $15,000 of cash, put it back in your non-retirement account, buy the same S&P 500 exchange traded fund, and you basically have just gotten the tax deduction and avoided the capital gains tax. However, you've got to make sure that the stock, that the investment that you are donating has a long-term capital gain. If it has a long-term capital gain, then your deduction on your taxes for your charitable donation is on the market value of the assets that you donated to the donor advised fund. If instead of it being a long-term capital gain investment, it's a short-term capital gain investment, then your donation is not going to be equal to the market value that you donated. It's going to be equal to your cost basis, which is basically what your original investment was. So going back to that example, say instead of, say somehow the S&P 500 index exchange traded fund that you purchased, you contributed 10 grand, it grew to 15 grand, but it did that. It grew that $5,000 all in 11 months, okay? That's a short-term capital gain. If you then try to do this creative tax planning strategy and donate that appreciated exchange traded fund to your donor advised fund, you wouldn't be able to get a deduction for the $15,000 market value. You'd only get a deduction for the $10,000 that you made, that you originally made the contribution of. So that's the gotcha that you need to look out for. This strategy, if you think you're going to itemize, okay, and you've got appreciated investments outside of your 401k and outside of your tax shelters and your charitable, all those planets need to align for this strategy to make sense. So it's going to rule out a lot of folks. But if it does make sense for you, oh my goodness, it's extremely potent in helping you with your tax planning. Could even create more deduction, so allow you to do more Roth conversions. I mean, you could add even more tax planning strategies to this, but you got to avoid that gotcha to ensure that you're donating long-term capital gain appreciated investments, not short-term. Work with your certified financial planner to see if this creative tax planning strategy or one similar makes sense for your situation so that you can get the goodness and avoid the gotchas. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.